Most of us think of the stock market as a simple line wiggling up and down on a screen. But if everyone is looking at the same data, why do individuals consistently lose money while massive institutions consistently win? That standard price chart masks the forces that drive the market. It only shows you where the price has already been, hiding the reasons why it moved there in the first place. The real engine behind every movement you see is liquidity. When you only react to the direction of a line, you aren't really trading the market. You are providing the fuel that professionals use to make their profit. Surviving this environment means looking past the surface. You have to learn to read the invisible forces that are pushing the price forward or forcing it to stop. Analyzing the market is like watching a car on an obstacle course, driven by two opposing forces. The first force is a market order, the gas pedal. These are aggressive buyers or sellers demanding to trade right now. They burn fuel to force the price to move. The second force is the limit order, the brakes. These are passive, resting orders waiting at specific price points. When the car's momentum hits them, they absorb that energy and slow the movement down. Sometimes the aggressive fuel of a market order hits a massive wall of these resting brakes. The engine is still pushing, but the car stops at the barrier. This stalling effect is called absorption. It occurs when the resting supply of orders overwhelms the aggressive demand, stopping the price without it moving another inch. Price moves when the gas overwhelms the brakes, and price stalls when the brakes absorb the gas. There is a third force on this track, the stop order. It's designed as a safety net for traders to prevent them from losing too much on a single trade. Beginners predictably hide these safety nets in the same locations, just above a recent peak or below a recent valley on the chart. In our car metaphor, these clusters act like hidden nitro buttons waiting on the track. These triggers are invisible until the moment they are hit. Once touched, they instantly turn into aggressive market orders, creating a sudden blast of gas. Placing these explosive momentum triggers in such predictable spots turns a trader's safety net into a weapon that institutions can easily use against them. Institutional traders have a scale problem. They need to execute massive trades, but if they hit the gas pedal all at once, they will cause the price to skyrocket and ruin their own entry price. To trade safely, they need massive breaks to absorb their giant orders. They need a surge of people selling exactly when the institution wants to buy. Their strategy is precise. They steer the price directly toward those retail nitro buttons, hiding past the obvious peaks and valleys. As the price hits those stops, panicked market orders fire off, creating a burst of forward momentum. This is a liquidity grab. Smart money uses that explosive retail panic to fill their massive orders, catching the energy to violently reverse the price. What looks like a stroke of bad luck on a line chart is a calculated maneuver. Institutions harvest retail panic to fill their own orders and secure their profit. If the brakes and nitro are invisible on a regular chart, how do professionals know where to steer? They abandon standard line charts. Instead, they use order flow tools that act as X-ray vision for the market. The primary tool for this is the Liquidity Heat Map. It shows where massive limit orders are being held over time. This tool highlights the massive walls of breaks. It allows pros to see where momentum will die before the price even gets there. Tracking these hidden barriers shifts trading from a guessing game into an observation of the measurable physics of the market. A simple line chart is a trap that obscures the actual mechanics of supply and demand. The market is driven by the interaction of three forces: aggressive gas, passive brakes, and the hidden nitro of predictable stop orders. An amateur blindly acts as the market's fuel. A professional navigates the obstacle course by using order flow to see the hidden barriers. By understanding the mechanics of liquidity, you can stop being the bait and start trading alongside the true forces driving the market.